Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now, let's break down what's happening in the markets today in a clear and simple way.
Yeah, and today's topic is definitely a big one.
It really is. So, I
Yeah.
want you to picture standing at your local pharmacy counter. You are there to pick up just a standard, everyday prescription.
Right, like maybe a daily blood pressure medication or, I don't know, a basic round of antibiotics.
Exactly, just the normal stuff. And the
Yeah.
pharmacist slides that familiar little paper bag across the counter and calmly informs you that the price is just completely out of nowhere tripled.
Ouch. Yeah, that is a terrifying scenario.
Right. But that exact scenario for American consumers has been burning through the financial news cycle lately. And it traces directly back to a major policy proposal from this past July 2026, where President Trump made headlines by floating these massive, like 100% to 200% tariffs on generic prescription drugs imported into the United States.
Yeah, I mean, it is absolutely the kind of headline that's designed to just instantly grab your attention and, trigger immediate concern across the whole healthcare sector.
Oh, for sure. On the surface, it sounds like a straightforward, if maybe extreme, trade policy. But when you start looking at the recent data and market analysis, this goes far beyond just a simple border tax.
Way beyond.
Right. We're looking at a really multi-layered political and economic package. I mean, it ties into the November midterms, the security of the global supply chain, and these really high-stakes international trade negotiations. So today, our mission in this deep dive is to break down the actual mechanics of this proposal. We are going to explore how it operates, why your wallet is caught in the crossfire, and how the stock market is digesting the news.
And just to set the ground rules for our analysis today, we are strictly looking at the economic data, the market reactions, and the strategic mechanics behind the policy.
Right, completely neutral.
Exactly. We are entirely neutral observers here. Our goal is simply to read the board, understand the economic levers being pulled by the current administration, and then translate what those moves actually mean for investors and everyday consumers.
Perfect. So diving into the mechanics, the initial headlines just scream about this 200% tax hitting your medicine.
Which sounds catastrophic.
It does. But reviewing the actual timeline outlined in recent Reuters reports, it reveals a much slower burn. The administration has structured this in very specific steps. So starting on August 1st, 2026, the tariff is actually set at 0% for 2 full years.
Right, 0%. That's key.
Yeah. It isn't until August 2028 that a 100% tariff kicks in for a single year. And then finally in August 2029, it jumps to the full 200%.
And that delayed trigger, that is the most critical element of the entire proposal.
It's essentially like a landlord giving you a 2-year warning that your rent will triple unless you start helping to renovate the building today.
That is a great analogy.
Right. It functions as a highly aggressive, high-pressure negotiation tactic, but it has this ticking clock attached to it.
Exactly. The structure of that timeline is, well, it's a textbook onshoring strategy. The administration is very well aware of the logistical realities of global pharmaceutical manufacturing. I mean, moving a chemical plant or a sterile manufacturing facility, that is a massive undertaking.
It's not like moving a shoe factory.
No, not at all. You have to navigate these intense FDA approvals. You have to build clean rooms to exact specifications, establish really complex water purification systems. It takes years.
So by putting this 2-year grace period on the table, they are deliberately giving global pharmaceutical giants, companies like Sandoz or the massive suppliers based in India, a very distinct window of time.
Right.
The message is basically clear. You have 24 months to break ground on factories here in the U.S., reroute your supply chains, or offer major policy concessions. So the primary objective isn't necessarily to collect a massive tax in 2029.
Right. It's not about the tax revenue at all.
Exactly. The goal is to force private corporations to invest billions into American infrastructure today.
And that points directly to the deeper strategy at play here. The tariff is merely the leverage being used to alter corporate behavior.
Okay, so I understand the mechanics of the timeline now, but the specific target of this policy is honestly a bit puzzling to me.
How so?
Well, based on FDA data, generics make up over 90% of U.S. prescriptions, yet they account for just a fraction of total drug costs. They are basically the flour and eggs of our healthcare pantry.
The flour and eggs, yeah, I like that.
Right, they're the absolute lowest cost, fundamental necessities for survival. So making the cheapest, most essential items more expensive, it just seems deeply counterintuitive for a domestic economic agenda.
It does seem that way, yeah. But that confusion really clears up when you look past the pharmacy counter and focus on the global map. Fundamentally, this policy views medicine through the lens of national security.
National security, like military level.
Exactly. Post-pandemic, there has been a massive paradigm shift in how governments classify critical supplies. A basic generic antibiotic is now viewed with the exact same strategic importance as, say, a semiconductor microchip or a lithium-ion battery.
Oh, wow. Okay, that puts it in perspective. And looking at recent estimates from the Financial Times, about 70% of U.S. generic drugs are sourced overseas.
70%, just think about that.
That is a staggering reliance on foreign production for just the basic staples of American healthcare.
It really is. And drilling down into the trade data reveals an even deeper vulnerability. So in 2025, India exported about $9.7 billion in pharmaceuticals to the U.S.
Which is huge.
Right, that represents roughly 38% of their total drug exports. So on paper, the U.S. relies heavily on India. However, the manufacturing reality is that India relies heavily on China for what are called active pharmaceutical ingredients, or APIs.
Okay, wait, let's define APIs for a moment so we don't lose anyone.
Sure, go ahead.
So when you take a generic pill, the vast majority of it is just like inactive fillers and binders. The API is the actual active chemical compound that treats your illness, right? The actual medicine part.
Precisely. And synthesizing that active chemical is a really complex, often environmentally hazardous process. The current global supply chain operates kind of like a massive funnel.
A funnel? How so?
Well, it starts with raw chemical synthesis in these massive vats in China. Those raw intermediate chemicals are then shipped to India, where they are further processed, compounded into the final active ingredient, and then finally pressed into pills. And only then are they exported to pharmacies in the United States.
Wow. So we are basically at the very end of a remarkably long and fragile hose.
That is exactly what it is, a very fragile hose.
If a geopolitical event causes someone to step on that hose in China or India, the American healthcare system simply runs out of medicine.
Yes. And the administration is citing that exact pipeline as an unacceptable national security threat. The tariff proposal is an aggressive attempt to just sever that foreign dependency. They are reclassifying basic medicine as a vital national security asset because they calculate that relying on a low-cost foreign pipeline is just too dangerous in the current geopolitical climate.
Okay. But given that rebuilding domestic chemical manufacturing takes the better part of a decade, the sudden surge in this tariff rhetoric, specifically in July 2026, it points directly to the political calendar, doesn't it?
Oh, absolutely. We are just months away from the November 2026 midterms.
Right. And the intersection of trade policy and election cycles is just impossible to ignore here. I mean, from a political messaging standpoint, pledging to revive U.S. manufacturing and punish foreign supply chains, that is incredibly potent.
Yeah, it's a message that fits perfectly on a bumper sticker.
Exactly. Because the alternative for lowering healthcare costs would involve reforming pharmacy benefit managers, or PBMs.
Ugh, PBMs.
Right. For those who don't know, those are the massive corporate middlemen who negotiate drug prices between the manufacturers and the insurance companies. Trying to explain the structural flaws of PBMs to everyday voters is, well, it's an uphill battle.
It's nearly impossible in a 30-second ad.
Exactly. But threatening a foreign country with tariffs, that captures the deeply emotional cost of living issue for voters while projecting strength to the voter base.
Yeah, and beyond the domestic political theater, there is a really complex macroeconomic layer to consider here, too.
Okay, lay it on me.
So a 2026 ARC6 study recently modeled U.S. tariff wars, and they found that the revenue-maximizing tariff rate for the United States is actually only about 20% to 30%.
Okay, wait, let me make sure I have this straight. Meaning, if the government's goal was actually to collect the maximum amount of tax revenue, they would set the tariff at like 25%.
Exactly. If you push it to 100% or 200%, the trade simply halts and the government collects zero revenue.
Which just confirms that these massive percentages are pure leverage. The administration is using these huge numbers as a crowbar to pry open better trade deals across the globe.
A giant crowbar, yes.
Yeah.
And July 2026 is a significant pressure point. The U.S. is expecting to finalize a major trade deal with India in the next few months.
Oh, interesting timing.
Very. And simultaneously, they are engaged in intense negotiations with Canada and Mexico to update the USMCA, the United States-Mexico-Canada Agreement, which replaced NAFTA.
So by threatening to upend the entire generic drug market, the U.S. administration basically creates chaos and puts its trading partners on the defensive right before these critical summits.
Exactly.
They can walk into the USMCA talks with Mexico and Canada or the bilateral talks with India and use these pending drug tariffs as a bargaining chip to extract concessions in completely unrelated industries like, I don't know, agriculture or automotive manufacturing.
Yeah, and to justify swinging this crowbar around, the administration frequently relies on the concept of most favored nation status.
Most favored nation, right? Let's break that down for the audience.
So, in standard international trade under the World Trade Organization, most favored nation simply means a country must offer the same trading terms to all its partners. You cannot play favorites.
But the administration is kind of turning that logic around to argue about free riding, aren't they?
Yes, exactly. Because the United States pays exorbitant prices for patented brand name drugs, we essentially fund the research and development for the entire global pharmaceutical industry.
Right. So the argument is that American consumers heavily subsidize all this medical innovation, while countries like India and China just get to enjoy the benefits of cheap generic manufacturing once those patents expire.
Exactly. So by proposing 200% tariffs, the administration is signaling a willingness to just tear up standard trade rules and rewrite the terms of global market access to correct what they view as a fundamental imbalance.
That makes sense. But, when a president threatens to triple the cost of doing business for an entire sector, the logical expectation is an absolute bloodbath on Wall Street.
You would think so, yeah.
Yet, looking at the data from the Wall Street Journal following the announcement, the market reaction was remarkably subdued. I mean, pharmaceutical stocks dipped, but there was absolutely no crash.
No, barely a blip.
Right. Sandoz fell 3.2%, Fresenius dropped 1%. Even the major Indian pharma players like Lupin, Aurobindo, and Dr. Reddy's, they dropped between 2% and 4.3%. That is barely a volatile afternoon in the markets.
Yeah, and institutional investors did not panic because they're reading the fine print of that 2-year timeline we talked about. They recognize a negotiation tactic when they see one.
They know it's a bluff, or at least an opening bid.
Right. They know these companies have ample time to deploy armies of lobbyists and strike deals before a single cent is ever paid. But there's another reason. The muted market reaction also stems from Wall Street identifying a massive, massive structural flaw in the economic math of this policy.
Yeah, looking at the basic business model of generic drugs, the math completely breaks down under this policy. According to the Association for Accessible Medicines, generics operate on razor-thin margins. We are talking about fractions of a penny in profit per pill.
It is incredibly tight. The profit model relies entirely on massive global volume and rock-bottom manufacturing costs in Asia.
Right. So this feels like passing a law that forces a dollar menu fast food franchise to suddenly start grilling premium, locally sourced Wagyu beef.
Wagyu beef on the dollar menu. Good luck with that.
Exactly. You can mandate that they buy the expensive American product, but if they are legally or contractually forbidden from raising the price of the burger above $1 single, the restaurant instantly goes bankrupt.
That analogy perfectly illustrates the policy's central weakness. Look at it this way. When the U.S. government wanted to bring semiconductor manufacturing back to America, they passed the CJPS Act.
Right, which was massive.
Yeah, and that legislation utilized carrots, offering billions in direct subsidies and massive tax breaks to offset the incredibly high cost of building those complex factories in Ohio or Arizona.
So the government essentially paid those tech companies to come home.
Exactly. But this generic drug policy, conversely, relies entirely on sticks. It uses the threat of punitive tariffs. If a manufacturer bends to the pressure and builds a generic drug facility in the U.S., their labor, their environmental compliance, and their overhead costs just absolutely skyrocket compared to operating in India.
And this is where those pharmacy benefit managers, the PBMs we mentioned earlier, become a massive bottleneck.
Yeah, a huge bottleneck.
Right, because the manufacturer goes to the PBM and says, look, it costs me 10 times more to make this blood pressure pill in America now, so I need to raise the price. And the PBM, whose entire business model is ruthlessly capping costs for insurance companies, simply refuses to pay the higher rate.
Yeah, they just say no. So the manufacturer is caught in this impossible squeeze between the government's tariff stick and the PBM's price cap. And since they cannot operate at a loss, their only viable business decision is to stop manufacturing the drug entirely.
Wow. Which means the policy intended to secure our drug supply could actually trigger immediate severe shortages of critical daily medications across the entire country.
That is the fear, yes. And Wall Street understands this structural roadblock. Investors are basically betting that the administration will ultimately back down from the full 200% tariff, or they will be forced to introduce massive subsidies to bridge the gap, rather than risk widespread drug shortages right before a major election.
That makes total sense. So for the individual investor listening to this, trying to navigate this landscape, the rules of engagement for healthcare stocks have completely changed.
Completely.
I mean, traditionally, healthcare was viewed as the ultimate safe defensive play in the market. The logic was always simple. No matter how bad a recession gets, people still need their medicine.
Yeah, that conventional wisdom is rapidly becoming outdated. Healthcare is now heavily influenced by geopolitics. It is entering the exact same volatile category as defense contractors, semiconductors, or energy companies, where just a single trade negotiation can alter a company's valuation overnight.
This means you, as an investor, have to evaluate companies based on geography and supply chain resilience, rather than just looking at the underlying science of their medicine.
Exactly, you have to look at the map.
Right. And looking at the data, the most vulnerable companies in this new environment are those heavily reliant on U.S. sales but lacking domestic manufacturing capabilities. Firms like Canada's Apotex or some of the major European and Indian exporters, they face serious headwinds if they cannot rapidly adapt their supply chains.
But conversely, the resilient players are the companies that already possess established U.S. manufacturing footprints. Additionally, investors really should look closely at companies heavily invested in biosimilars.
Biosimilars. Those are incredibly important distinction
They're
here.
very important.
So unlike standard chemical generics, which are relatively simple to synthesize, biosimilars are large molecule drugs made from living organisms. They are highly complex to manufacture, and they're often used to treat really serious conditions like cancer or rheumatoid arthritis.
Right, and because they are so difficult to produce, they command much higher prices and significantly wider profit margins.
Yeah, and JP Morgan actually recently published an analysis noting that a company like Sandoz might be insulated from these tariff shocks specifically because of their strong portfolio in high-value biosimilars and their existing U.S. footprint.
Exactly. The wider profit margins on biosimilars provide this financial cushion that allows them to absorb supply chain disruptions that would frankly bankrupt a traditional cheap generic manufacturer.
So the big takeaway for anyone analyzing this sector right now is to avoid reacting to the dramatic headline numbers.
Ignore the panic.
Right. A 200% tariff sounds catastrophic, but according to the data, the real secret to surviving and profiting in this volatile market lies entirely in the exemptions.
Tracking those exemptions over the next 24 months is crucial. I mean, the key question is the ultimate scope of the policy. Will the tariffs apply only to the finished, packaged pill entering the country? Or will the administration aggressively target those raw, active pharmaceutical ingredients we discussed earlier?
Oh, that's a huge distinction. Because if they tax the raw chemicals coming out of China, even a state-of-the-art factory built right in the middle of Texas gets hit with a tariff, which renders the whole onshoring effort totally moot.
Exactly. Investors will also be watching to see if simply bottling and packaging foreign-made pills within U.S. borders satisfies the administration's requirements. The market will reward companies that secure long-term government contracts or successfully build domestic infrastructure, and it will punish those that ignore the geopolitical shift.
There is also a broader macroeconomic risk shadowing this entire debate, which analysts are currently calling tariff-driven reinflation.
Yeah, tariff-driven reinflation. Tariffs are inherently inflationary. I mean, they operate directly as a tax on consumption.
Right.
If the cost of raw chemical materials increases and the cost of manufacturing surges because it is forced into a higher wage domestic market like the U.S., that financial burden cascades down the chain. It adds direct inflationary pressure to broader economic metrics like the Consumer Price Index.
And it's hitting a healthcare system that is already financially straining the average household to begin with.
Exactly.
Which kind of brings us full circle back to that terrifying scenario at the pharmacy counter. We have clearly established that relying on a brittle pipeline stretching from China to India to supply the fundamental staples of American healthcare is a genuine national security vulnerability. The comparison to securing microchip manufacturing really holds up under scrutiny.
It does. It's a real vulnerability. But securing that vulnerability, however, demands a steep financial sacrifice.
Wow.
If this high-stakes pressure campaign succeeds over the next 2 years. I mean, if the threat of unprecedented tariffs genuinely forces the global pharmaceutical industry to dismantle its Asian supply chains and rebuild them on American soil, the structural cost of manufacturing medicine will rise permanently.
So basically, the era of dirt cheap, globally sourced generics that cost just pennies a pill
Hmm.
will effectively be over forever.
Yeah. And the lingering, vital question we have to answer as an economy is who is ultimately going to absorb that massive, permanent price increase?
That is the million-dollar question.
Will the deeply entrenched insurance companies and PBMs willingly sacrifice their profit margins? Will the federal government step in with endless subsidies funded by taxpayers? Or will you, the consumer, be forced to pay the price the next time you go to pick up your daily prescription?
That is a very complex and highly consequential reality to leave our listeners with today. The pursuit of national security rarely comes without a hidden cost to the consumer. Well, that is all the time we have for today's deep dive. Thank you for joining us as we unpack the hidden layers of the markets. Don't forget to subscribe and hit that like button.